We're looking at what determines an exchange rate, and all an exchange rate is the price of one currency in terms of another. So there's a market for currencies, which is the international foreign exchange market, and some people want pounds, some people want dollars, so a swap, and that gives rise to forces of demand and supply internationally. So the price of the pound in dollars is simply the exchange rate of a pound. So it could be the market for bananas, the market for apples. If more people want bananas relative to supply, the price of bananas will go up. Same with the pound. If more people want the pound, there'll be more demand for the pound relative to the supply, and the price of the pound will go up. Okay, so let's look at some specific factors that will determine the exchange rate. To illustrate this, you just need to draw a demand and supply diagram. In this case, we're showing appreciation because the demand curve shifting to the right and the supply curve shifting to the left for the pound. In this graph here, which is maybe a more simple one, we're showing depreciation, which is a fall in the value of the pound, rather than here an increase in the value of the pound relative to the dollar. Here the pound is, say, falling, instead of being equal to, say, $2, might become equal to $1. Why? Because there's less demand for the pound. So we move from point A, if you like there, to point B. Okay, let's look at some specific examples of what determines exchange rates on the foreign exchange market. So the first thing we might look at is trade and competitiveness. If a country like the UK, and we'll look at the UK as an example, becomes more competitive, extraordinary, I know you might say, and say we actually export more, okay, and import less, then this is illustrated in this diagram. Because if we export more, then there'll be more demand for our pounds. Because to buy our exports, the United States will have to sell dollars and buy pounds, as represented by the demand curve. So if they're buying more pounds, the demand curve will shift to the right. And therefore this will push up the value of the pound. Also, of course, if our goods are more competitive, we might import less. So if we import less, then we will supply fewer pounds to the foreign exchange market to buy those imports. Because whenever we buy an import, okay, like this lovely iPad here, or this lovely iPhone, then what we do is we supply a pound to the foreign exchange market to pay for this phone in dollars, to exchange it for dollars. So if there are fewer imports, there'll be fewer pounds supplied, so the pound will shift, the supply curve, the pounds shift to the left. So the exchange rate will increase from ER1, say £1 being equal to $1.50, to £1 being equal to $2, say ER2. So the exchange rate strengthens, the pound strengthens. And this will happen, as illustrated by this diagram, because our goods, say, become more competitive, say more non-price competitive, or productivity increases. So we export more, we import less, and the exchange value of the pound will increase. A second factor could be inflation. Inflation, say, was lower in the UK than, say, the United States. Okay. Over time, this would make our goods more price competitive. So over time, the same thing would happen. There'd be more exports and fewer imports. So the demand for pounds would shift to the right, and the supply would shift to the left. Another factor could be interest rates. Interest rates are a key factor in determining exchange rates. And if the interest rate, say in the UK, was to rise relative to the USA, and incidentally we're talking inflation in the UK relative to the USA, so if interest rates in the UK were to rise relative to the USA, what will happen is that hot currency flows will shift from the USA to the UK. Why? Because they're making a greater return. So in the world there are billions, if not trillions, of pounds or dollars, or certainly foreign currencies, that move around to where they're going to gain the highest interest. These are sometimes called footloose currencies, for obvious reasons, or hot money. And hot money will move to where the interest rate is highest. So if the UK interest rate increases relative to that of the United States, then there'll be a flow of hot money to the UK, which, as you know, will be on the capital account, short-term flows, the financial account of the balance of payments. That money coming in means there'll be more demand for pounds, so demand curve will shift to the right. It might possibly mean that more currency stays in the UK, so people might sell their assets in the United States and bring the cash back to the UK, which will affect the supply of pounds. So the key thing is interest rates are a key determinant of currencies throughout the world, and the hot flows of money happen quickly. But another area is speculation and portfolio investment. If you think the currency is going to go up in the future, then obviously you can make money by buying that currency now. So flows of hot money will go into currencies if there's speculation that in the future it's going to rise in value. So these speculative funds are often based upon latest economic information and indeed political certainty, but also on confidence. So if there's good news from the UK and they say expect a certain government to be in power or some economic benefit to the UK, then there'll be a flow of currency into the UK, expecting the exchange rate to increase, and of course it will. So that will result in the demand curve shifting to the right and the pound increasing in value. Another action could be if a country reaches a debt crisis. So if a government borrows too much and is likely to default on the debt, what's likely is people will sell their bonds and there'll be less demand for UK government bonds, which means that there'll be less flow of money, hot money into the UK, so the demand curve will shift to the left for the currency and the supply curve will shift to the right, resulting in a depreciation of the currency. As we can see in this diagram here, the demand curve shifts to the left, and we could of course shift the supply curve to the right and show a depreciation of the currency. So basically there are four really important factors: trade, competitiveness, inflation, interest rates, and what's happening to speculative demand, what people think is going to happen in the future. But also government debt could be a factor, and of course another factor is foreign direct investment. If a country like the UK becomes attractive to foreign investors, which has certainly been the case in recent decades, then what will happen is there will be an inflow of capital into the UK. So say Nissan and other companies build car plants in the UK, then that will give rise to demand for pound sterling, and the demand curve will shift right. So that's another long-term capital flow and another factor that determines the exchange rate. So exchange rates in practice are highly volatile because there's colossal quantities of money that shift around the world based upon speculation in order to make a quick buck. But there are other key flows as well, and it's very important for trade as well. So I hope that's useful and these diagrams are useful. Thank you very much.